Now, we've got a great panel of experts who will share their insights, best practices, and practical strategies. We'll cover enhanced due diligence techniques, compliance frameworks, might touch upon technology solutions, and the importance of more actually ongoing monitoring of these relationships. And we aim to, as much as we can, leave you with the knowledge and the tools you need to navigate this fascinating world of private banking and high-risk customers in general. So let me introduce you to our panels. I'll start with a lady in the room, Anna. Anna is from Cyprus, same place I am coming from. She's the founder of AML Tube, compliance and AML expert, and obviously a faculty member for GCI. Anna brings over 2 decades of experience in the financial industry sector. We actually worked together in one of the banks in Cyprus a few years ago. As the founder now of AML Tube, her company aims to demystify financial crime and educate individuals on its workings with an extensive background in banking, electronic money services, and the investment industry. Anna possesses a deep understanding of compliance requirements within the financial sector. Anna's passion does not stop there. I know that Anna has a particular affinity for the crypto industry, and she's especially knowledgeable in the field of crypto, AML, keeping a close eye on regulatory financial crime developments, both in the EU, but also globally. Anna works tirelessly to ensure that companies meet their AML regulatory obligations. Holger Paco Tischer, friend for many years, a passionate senior financial crime professional who brings a wealth of experience and expertise to the table. He warned me that his CV is quite long, but I'll try to make it as small as I can. With a remarkable international background, he has gained a strong reputation in the national and international anti-financial crime field. He has a unique blend of knowledge and hands-on experience. He's recognized as an SME in financial crime. He's actively involved in conducting comprehensive training programs and frequently invited to speak at international conferences and symposiums. His professional journey is quite impressive. He started as an analyst, but he worked his way up the ladder to eventually shoulder global responsibilities at one of Germany's largest banks. Driven by this passion and desire for new challenges, Holger made a transition into the consulting field, where he continues to make a significant impact. Last but not least, Faisal Islam, great friend coming all the way from Canada. Director of Compliance and RegTech at Paradigm FinTech, who actually offer services to European FinTech and banks, specializing in go-to-market strategies, platform development and integration, and regulatory compliance training. He plays a pivotal role in assisting FinTech companies and banks in devising and executing their compliance, due diligence, and payment product programs. And within RegTech, he also focuses on SME and strategy, providing valuable insights and guidance to drive success. His expertise obviously extends beyond his role. He's also a writer, a trainer, and a speaker, and his passion lies in making tangible difference in the world of compliance. So thank you all for being here today and joining me in this exciting webinar. And I think, given time constraints, let's start with a discussion. And Anna, if you don't mind, I will start with you. How important do you think it is to identify those high-risk customers? We talk about risk assessment, we talk about risk-rating customers, but how important is it to, out of all the customers in your portfolio, to identify those high-risk customers? And our topic today is private banking. What are those risk factors that are unique to private banking customers compared to, say, retail banking or commercial banking or corporate banking?
So hello from me to everyone. Thanks for the introduction, Greg. Now, why it is important to identify high-risk customers? It's important, not only important, it's essential, it's vital for an entity to identify these high-risk customers. Why? Because if an entity fails to identify these clients, it's exposed to extreme reputational, financial, and compliance risk. Why? Because these high-risk customers are the customers which have a higher probability to be involved in criminal activity, in money laundering, terrorist financing, or fraud, or any other criminal activity. They have specific characteristics that increase their regulated entities' exposure to money laundering, because if they are involved in any criminal activity, they need to pass their illegally derived funds through the financial system. So how are they going to do that? With the use of a bank. And this is why a bank is exposed. Not only bank, any regulated institution can be exposed to extreme money laundering, terrorist financing risk if they fail to identify the risk associated with each and every high-risk customer that they have. Now, regarding the second part of your question, what are the risk factors that are unique to private banking customers? As you have stated in your introduction, private banking customers offers private banking departments offer their services to wealthy and in some cases to ultra wealthy clients. And these clients, they have specific needs that retail clients don't have. For example, a retail client, what does a retail client need? They need a bank account, car payments to pay their bills, and this type of services. Now, the wealthy clients have other needs to preserve their wealth, to grow their wealth, and they need hedge funds, they need structured products, investment advice, family offices in some cases, tax planning advice also. So these are the difference between wealthy clients and retail clients. And to achieve these objectives, wealthy clients, they often need cross-border services, in some cases international services, and they have links to multiple jurisdictions. They are part of complex, they use complex ownership structure for tax efficiency. And these are why they have higher risk of being involved in any any criminal activity or money laundering, and this type of illegal activities. Additionally, private banking often attracts PEPs, which are vulnerable to corruption and bribery. And again, it's important to identify these PEPs and conduct enhanced due diligence to ensure that the company understands the risks associated with these types of clients.
Thank you very much, Anna. And we'll come back to enhanced due diligence in a bit. But before we do that, Holger, I know in the past we have had some discussions on this. With the Panama Papers back in 2016 or 2017, there was a lot of discussion around shell companies, and we've done some trainings together on shell companies and how they can be used to launder criminal funds. How can we define shell companies, and how are shell companies used in private banking? There are some definitions out there, and some regulators have made it a bit more streamlined and a bit more specific. But over and above the definition, do you have some examples to share so that we can understand the risk with shell companies?
Absolutely. So first of all, a shell company is nothing bad or evil. A shell company can be used for multiple completely legitimate reasons, and it's very often used in private banking for some reasons which I will explain in a moment. So first of all, to answer your question, what is a shell company? A shell company is a company with no physical presence, with no employees, with no actual productive activity. It's just there in the context of private banking to hold assets and to hold wealth. In a lot of occasions, and this is something we have seen in the Panama Papers, it is actively managed by what we call a trust and company service provider, which Mossack Fonseca was. Because of the various risks connected to shell companies in private banking, this trust and company service providers are also nowadays obliged entities under many AML laws and regulations. So when a company is used for the sole purpose of shielding the beneficial owners, of avoiding that banks and other financial institutions comply with their legal obligations to identify the persons behind it, then it is something going into the field of illegality, and this is the same as with criminals. It can be exploited. Sometimes there are legitimate reasons for using a shell company to shield the beneficial owners, especially for people in high risk jurisdictions, where we have a high level of crime, where rich people are also getting kidnapped for ransom. Those shell companies are used also to protect this rich individuals. So as a private banking organization or someone else dealing with shell companies, the important thing is to understand, why is there a shell company? Why are we not dealing directly with a customer, but why is it shielded by a shell company or a series of shell companies until we reach what we call the ultimate beneficial owner? And this is our legal obligation. Companies or any other legal entity is never founded, never funded, and never acting on its own. There's always natural persons behind it, and this is what we need to identify. So what are reasons for a shell company in the context of private banking? And Anna already mentioned some. Sometimes it is for a tax optimization, which is not the same as tax evasion. So if it's used for tax evasion, obviously it is illegal, but there are complete legal means to reduce your taxes. One example is that in some of the states in the United States, if you acquire property as a natural person, you need to pay property tax. If you acquire it as a legal entity, you don't need to pay it. And this is a complete legal loophole to reduce your tax. Another reason is companies don't die, people do. So if I'm a filthy rich individual and all of my assets are held by a shell company, and I die, it's just the business is going on. So the banks don't need to stop. It's just continuing to manage my wealth. It's only that all of my wives and boyfriends and girlfriends and kids and whatsoever are just quarreling in the background. And at one point, the banks will rewrite who's the beneficial owners and who's the controllers. But if I'm holding it on my own name, there is a full freeze as I'm dying until all of these quarrels are set. So this is one of the main reasons to really hold and manage assets and to ensure that there is a consistency independent of a natural person.
Yes, and I guess, you know, all this falls under the basic definition of private banking, right? You know, they've got all this wealth. They need to sort of hide it in a way that makes sense. Usually the customers get advice from different trust and corporate service providers as to how to set up their different structures. And you know, it does make sense for them to use these sort of companies at some point. But going back to our discussion with Anna, you know, we've got these complicated structures, these complicated customers. What happens when you come across a private banking customer or, you know, high-risk customers for that matter? You mentioned enhanced due diligence. What is enhanced due diligence? A lot of times people are confused, right? And I think we've reached a point where customer due diligence and enhanced due diligence in some cases is not very different, and there is a bit of confusion. But what is enhanced due diligence, and how is it different to customer due diligence?
So first of all, enhanced due diligence is building on customer due diligence, and this is what a lot of people don't see or understand. Our obligation is to comply with customer due diligence, so legally defined steps in the laws and regulations. If we identify higher risk, then we need to do additional steps, which is called the enhanced due diligence. And in a lot of occasions, enhanced due diligence is doing more of the same. So we are identifying now 10% ownership threshold instead of 25. We are having further approvals. We are doing further due diligence. And one of the things we need to do, I think we will also come to this later on, is to identify the source of funds for our specific relationships. And this is important to remember. EDD builds on CDD, and it's different from what we call KYC. Even all of this is sometimes mixed. We are in a position, and this is a very good observation of you, where a lot of banks increase their normal due diligence measures, their CDD measures, already to a point that the difference between enhanced due diligence and a customer due diligence is not so much anymore. But in general, enhanced due diligence means we are doing more screening, we are having more scrutiny, and the most important part is we are reviewing our customer relationship more often than we would do it with a normal customer. So in most international banks, we have review cycles of 1, 3, and 5 years. So low risk customers every 5 years, and in the same time we review our high risk customers 5 times in order to ensure that all of our information is valid, that nothing changed, and that we are aware of all the risks and no new risk emerge. So the reason of this periodic review cycles, this very tight review cycles, is to ensure that we are aware of the risks.
Thank you, Holger. Anna, any thoughts on that? Anything you want to add?
Yes, I would say that customer due diligence is mainly comprised of some steps: identifying and verifying the customer, identifying, verifying the beneficial owner, understand the purpose of the business relationship, and ongoing monitoring, which includes customer reviews and transaction monitoring. Enhanced due diligence is actually customer due diligence plus. Plus what? Plus additional information. So in high-risk customers, we need to obtain additional information about the customer, more information to understand the risk associated with the business relationship, establish the source of wealth and source of funds, as already stated by Holger, information about transactions, enhance transaction monitoring. For example, for a retail client, we can identify, verify the client with the use of an ID. Maybe we can ask a utility bill for the address, a pay slip to confirm his salary. But for a high-risk customer, this is not enough. We need to obtain additional information to understand this complex risk profile. It's like taking our customer due diligence to another level. We need to establish source of wealth. For example, we can ask business ownership documents, sale of assets documents. We can ask for inheritance documentation, tax information, dividend information to establish the source of funds, and other information to identify the source of wealth. So there are differences between customer due diligence and enhanced due diligence. In my mind, I have it customer due diligence plus additional information equals enhanced due diligence.
True. And Faisal, give me one more minute. I will come to you. Before I do, though, I want to ask Volker actually one more question. In private banking, there's a lot of talk about gifts and entertainment. And we had the discussion before, right? In private banking, gifts exchange can sometimes, be far from symbolic. Formula tickets to other high-profile events, yacht parties, cruises, and I know you like yacht parties and cruises, and things like expensive bags. Michelin star restaurants, expensive hotels, to name just a few. How is this impacting the management of risks in private banking, do you think? Holger, I think
I was talking to myself. Sorry. So it's just adding another risk to our managing of high-risk customers, and this is bribery and corruption risks. So you just mentioned Formula One tickets, and I remember one situation where customers were invited to Formula One race with a +1. Everything is paid, including hotels and so on and so on. And they even got an iPad where all of the stables, all of the drivers and so on, all of the information you need is already there. What happened is there was an escalation of these customers up to the global CEO, because how dare they invite us with a +1 and they only give us one iPad. So we are talking about people having dozens of millions of euros and US dollars, and they are very demanding because they know that with their wealth, with the business the bank is doing with them, they are also providing a lot of revenues. And private banking is very competitive because all of these individuals, they're not only dealing with one bank, they're dealing with multiple banks, with multiple jurisdictions. So they can also play those against each other and get what they're demanding. I also know that some wealth management banks have concierge services for their ultra high net worth individuals, where you can call the bank to get plane tickets, to get concert tickets, and so on and so on. This is a challenging situation because up to what level it is still appropriate and just to maintain a customer relationship, and at what level it is getting inappropriate, and it could be perceived as we are paying like kickbacks, or we are trying to give a client extensive gifts in order to get a relationship with him. So this is a very short line, and unfortunately there is no silver bullet for this solving the problem. It is really on a case-by-case basis to decide what is appropriate. There's also this element of social adequacy, what is adequate for this kind of customer, and at what level we are already getting in a gray or even in a criminal or forbidden area.
Thank you so much, Walter. And Faisal, thank you for your patience. And you are the guy I turn to for anything crypto related, and we've been doing this, having this back and forth for years. Why are cryptos high risk? We talked about private banking customers, and I'll try to put the two together in a bit. But why are cryptos high risk, and how is enhanced due diligence that Holger and Anna discussed different in cryptos? And what is it that we need to be comfortable with in this case?
Sure. Thanks a lot, Greg. So cryptocurrency customer groups fall into this really interesting category, not unlike sort of your retail category, where you've got your base customer profile and private banking customer profile. And crypto customers also fall into the same category, where you have your retail-based customer profile, and you also have high net worth individual, high net worth entities as well in the crypto space. The main reason is really twofold. First, and we have to go a little bit to the basics here. We've always known the 3 cycles of money laundering, but when it comes to cryptocurrency, layering itself, that stage is highly complex in cryptocurrencies. And so deconstructing layering attempts requires a higher level of sophistication, because the amount of sophistication required to impute layering was that much more difficult. That in itself is already very difficult. Second is integration in terms of cryptocurrency related illicit crime is much easier. And that's one of those things where in the traditional space, it's not as easy. So for example, at the end of your cycle, when you want to be able to buy yourself real estate with illicit funds, there is quite a bit of cost, and it also takes a little bit of time. Whereas with cryptocurrency, that last session of integration is far easier. And then finally, I always say that money laundering cycles are not 3 steps. There's actually a 4th step, which is repatriation. In other words, enjoyment. There's no point in laundering illicit funds if you can't enjoy it. There's absolutely no point to it. So in terms of traditional spaces, the repatriation takes also time, and it also takes a lot more effort. Whereas in cryptocurrency, there are fairly enough amount of suppliers in the service provider space that are willing to let you enjoy illicitly gotten gains from cryptocurrency. So that's the first reason why it's inherently difficult. Second is more a question of numbers. For every $1 million in the cryptocurrency space, roughly about 3,000 of it is illicit. Whereas in the traditional space, for every $1 million, roughly 80 cents is illicit. That inherent disproportionate risk in terms of density of illicit funds with regards to financial flow just makes it inherently more high risk. And we're talking about something in the order of magnitude of 300 to 3,000 times more. And so if you are a financial service provider that provides services to cryptocurrency risk, it's one of those things you have to be aware of. And finally, with regards to why enhanced due diligence is more difficult, is that delayering part has to do with not just a single cryptocurrency. A lot of times in your private banking clients that do hold cryptocurrencies, they hold multiple portfolios across multiple different types of cryptocurrencies and different investments as well. And a lot of the activity might sort of imitate an illicit actor, but not necessarily itself. And so sort of demystifying that layering complexity that's inherent to cryptocurrency is just inherently more difficult.
Thank you, Faisal. Today's sort of discussion is more about private banking customers, but we have those private banking customers in banks that actually deal with cryptos, right? It's becoming more common nowadays. So what about the private banking customer dealing with cryptos? And perhaps the product of the source of funds is cryptos. What do we need to ensure in this case?
Sure. I mean, let's start with why we even deal with private banking clients. In most commercial institutions, private banking clients and their returns are subsidizing the bank's effort to be able to cater to Main Street customers, right? The only way a bank or a financial institution can afford to provide a very low cost checking service, almost at a loss, to Mr. and Mrs. Jane and Smith out there. The only way they can afford to do and have loss leader products is actually catering to private banking clients, right? There's just no other way to be profitable in the banking space, even in the lending space, without resorting to having private banking clients. Now, a lot of these private banking clients, unlike other customer categories, are not sort of single-minded. They have multiple different risks and tastes and profiles across that spectrum. And so a few of them actually have a higher taste for a risk appetite and want to include cryptocurrency as part of their portfolio. As a result, one of the things they will do is that they will assign the private banker to come up with certain solutions to be able to do it, whether either exposing 5% to 10% of their portfolio to cryptocurrency and let it ride, so to speak. A lot of times, for example, a lot of the private banking clients, instead of taking the asset route, we're going to take the lending route and essentially take collaterals based on cryptocurrency holdings they have and then take on further risk as a result. The main reason why it's more difficult than not is it's hard to estimate sometimes what a private banking client's tastes might be. Private clients that have a taste for cryptocurrency might have tastes that change quite often, and a bank might not be capable enough or flexible enough to be able to switch on the go, especially with the way cryptocurrency market works and how fast it works and all the different innovations that come into space. It's just not capable sometimes for a bank to be able to adjust to that same profile. One of the interesting things that I've always found interesting with my clients that are in the private banking space is that they have profile meters. So they know, for example, certain their private banking clients, what they prefer buying, which type of manufacturers they go to, which designers they prefer, which artists they generally gravitate to, or at least the type of art that they gravitate to. And whenever they look at their purchase history and so on, a lot of the AML compliance folks actually look at, well, which type of painting did they buy? What category was it in? And if it differs from the category, let's look into it a little further because that's obviously out of their profile. Which designer handbag did they buy? That's usually not a designer handbag they actually buy. So let's look at it a little further. Why that differing taste? This kind of sort of profile customization that a lot of these institutions know very well about is hard to do for cryptocurrency, because if a initial cryptocurrency private customer was initially only in Bitcoin, but suddenly wanted to get into Ethereum and a few of the altcoins and certainly jump on and go on this latest new NFT and Web3 and whatnot, it's hard to keep track of it because you don't have sort of a profile that you can peg to and make sure you monitor the risk accordingly. That's the main sort of difficulty in that.
Fantastic. We might talk a bit more about cryptos in a bit. But there is a question I would like to ask Holger, and it has been a sort of a a long-standing discussion, and it is a discussion about golden passports. In Cyprus especially, we've had a lot of discussions about golden passports. In fact, a couple of years ago, there was an investigation by the Al Jazeera news channel that revealed that the head of parliament was caught making it easier for criminals to get a passport into Europe by making investments in Cyprus with possibly funds sourced from criminal activities. Cyprus immediately canceled the program and even canceled a number of passports, and they're still doing it. They've canceled a few passports a couple of weeks ago. What is your take on this? Why is this still happening around Europe, and what does that have to do with private banking? What is the connection there?
So why this is still happening in Europe is something that I really cannot answer, because there's so much negative media around it already, especially also nowadays in the context of the Belarusian sanctions, where the relatives, the sons and daughters and wives and whatsoever of the oligarchs can still freely travel through Europe with European passports acquired by this golden visa programs. First of all, what is a golden passport or golden visa means? It means that you are investing a significant amount of money in a jurisdiction, and by this you are getting the citizenship, and by this also the passport and the entrance to the European Union. Obviously, as you need to invest a significant amount, this is something which is very appealing to our private banking customers who have significant amounts of money, and I just want also to have the benefits of passports, access to the European Union, and so on and so on. Originally, they were set up as investment programs. So if you have someone investing heavily in your economy, it is it was seen as a kind of a reward for supporting the country. But nowadays, it is more like you're buying a citizenship. And this is, in my view, fundamentally wrong. It also poses quite significant risk for organizations. So first of all is taxation risks. So if we all know about this FATCA, about this CAM reporting standards, and so on and so on. We all know that we are sharing this tax information nowadays with our governments, and the government is sharing it with other governments. And this it's making it very complex for us to assess is a customer who's having citizenships is really in tax compliance, or if ever we are exploited to support some tax evasion of this customer. It's also posing significant challenges with regards to the current sanctions programs, which for the very first time is not only aiming at a jurisdiction or at specific persons and entities, but also at persons holding a specific citizenship, which is the Russian citizenship. So if you are a Russian citizen living in the European Union, you are also subject to certain restrictions if you are not also a European Union citizen. So with this the European Union citizenships acquired through golden passports, you're just being able to circumvent the sanctions completely legally. And with this, it's just adding a lot of complexity and risk to what we are already seeing.
And there were some private banks, right, in the past that would help people actually complete the application and submit the investments and do the whole thing. Just passports.
You mentioned the Panama Papers, and everything that we read about the Panama Papers, about what private bankers have been doing for their customers, all of this is true, and it is still true. I said that some banks having a concierge service for their high network customers. So if you are a Russian oligarch and you are having your account as a high net worth individual with a Swiss bank, you can just call them, said, look here, where I'm getting my European Union passport, and they are doing everything for you. So this is still nowadays, it is true that banks are going the extra mile to please this ultra high net worth individuals, including also advising them on the golden passport schemes and how to acquire the citizenship.
For sure. And, during this discussion, we mentioned PEPs a few times, both, in the private banking context, but also, talking about even golden passports. Anna, if you don't mind me asking, there are a couple of questions also in the chat. What about PEPs? What is the issue with PEPs? How can we protect ourselves from corrupt PEPs, if we work in financial institutions? And also, is the solution, to all these PEPs, other high-risk customers, just kicking them out, just, not dealing with them? What is your take on this?
So a PEP, what is a PEP? Is a person with a prominent public function, family member or associate. And what are the risks associated with PEPs? They have power, they have influence, and it's very easy for them to abuse their position for their benefit. Some PEPs also have access to public funds. How difficult is it for a PEP to accept a bribe, for example, from a company to secure that that company enters into a contract agreement with the government? Or how difficult is it for a PEP to embezzle public funds for his or her own benefit? So these are the risks associated with PEPs. It's very easy for them to be involved in money laundering, interest financing, and other illegal activities. Now, when dealing with PEPs and other high-risk customers, a financial institution has two options. First, de-risking, meaning kicking out the client, saying, I cannot accept this high-risk customer. Or the second option is accept the customer and take measures, enhanced due diligence measures, to mitigate the risk and ensure that the funds used throughout the business relationship, the wealth of the client, are not obtained through illegal activity. And we need to remember that PEPs also have banking needs. They have higher risk, but isn't there a way to mitigate those risks? Now, whether or not a bank will onboard or continue offering services to PEPs and other high-risk customers, or whether it will kick out the client, it has to do with the risk appetite of the regulated entity. Is the entity in a position to accept the client and continue offering its services to that client and mitigate the risk through enhanced due diligence? Or do we decide that, okay, we will not accept this client, we will kick him out, we don't want him? Both are options. It all depends on how much risk a company is willing to accept to achieve its objectives. So it all depends on that.
Thank you, Anna. And I think quite a few people agree with you. Yes, Holger, please.
Just one thing to add, Greg, you said a very smart thing at the start of the webinar. Obviously, you're saying a lot of very smart things. This one just is fitting in here very nicely. You said something about risk and reward, and this is something a lot of compliance professionals are ignoring. We are not doing business without taking risks. High risk is nothing bad, because a high risk should be also including a high reward. No regulator around the globe is telling a bank not to take on high-risk customers. The only thing they're telling them is you need to be in a position to adequately manage the risk. You need to be in a position where you have full transparency about the risks you are taking. And if so, then go for it. Because with high-risk customers, also normally higher rewards came. I just want to share one discussion I had with a private banker. He came to me and said, "Oh, Holger, if we're doing all of this enhanced due diligence with the customer, we are not making money anymore." And he saw that I'm saying, "Come, then let's don't do this or don't do that." But my answer was then, your pricing is wrong. So would you give a person like Gregory with triple A credit rating, the same interest rate in a loan than you would give for some poor freelancer like myself with a C or D credit rating close to default. No, you would not, because the risk with Holger is higher than with Gregory. So Holger is getting a higher interest rate because he needs to pay for the additional risk. And the same is also true, or should be true, with our AML measures. If we have a customer where we have a high risk, where we need to apply enhanced diligence, where we need to apply an annual review cycle instead of every 5 years, then we should also price them differently to make the risk worthwhile, to have the reward for the risks we are taking. And I think this is a very important concept also for compliance professionals to remember.
Yes, because many times we forget where the money is coming from, where salaries are coming from. We are working for businesses that want to make profit, right? So yeah, totally agree with you on that. And we often talk about high-risk customers, meaning customers involved in high-risk industries. We've already touched upon private banking, cryptos, gaming, which we have not discussed yet, Forex and so on. Faisal, when we were discussing this webinar together between us, you mentioned something that I found very interesting: telehealth, as well as the pharmaceutical industry, and the issues that merchant acquirers, payment facilitators, and banks have been facing over the last few months, especially the period since COVID. Could you perhaps take us through these challenges and what we can possibly do about them?
Sure. I mean, prior to COVID, the concept of sort of purchasing your telehealth needs and pharmaceutical needs online was not a very mainstream event. It was mostly only done in real life situations, on a counter basis, face-to-face, and so on. But because of COVID, a lot of these type of services and open to the services got turbocharged, where more and more people adopted telehealth services by consulting the doctors and physicians online in a virtual manner. Prescriptions being prescribed also in a virtual manner, and the medications also being acquired and purchased and shipped, and all in an online manner as well. As a result, the public just sort of got more comfortable and confident with this, but it didn't sort of erase a lot of the high risk histories that are associated with telehealth and pharmaceuticals. And mainly is a few things: sort of whether the patient is qualified and legally authorized to be able to ask for the service in the place that they're in, and whether the practitioner, the service provider, is authorized and legal to be able to provide that service as well. And on top of this, there's more additional risks with regards to medication. Who is supplying the medication? Where is it coming from? And so the problem statement is that acquirers and payment facilitators that board these type of sub-merchants, they really have a very difficult task in order to de-risk a lot of these service providers and pharmaceutical companies and pharmaceutical product suppliers as well, when they want to onboard them, because there's just a high amount of natural demand for this now than there used to be in the past. So there are sort of multiple steps that a lot of acquirers and pharmaceutical companies can do. Of course, onboarding these merchants, verifying the registration, checking the licensing permit, reviewing the prescriptions, and so on. It's quite important, but also checking the legality of where the jurisdiction of the patient is, as well as the practitioner. Also review, sort of deliver any type of delivery method of the prescription, whether it's compliant with shipping laws, patient data itself, whether it's stored in secure and compliant places. And at the same time, what are you de-risking methods for these pharmaceutical merchants? Now, I've compressed basically in 5 minutes what is naturally a very large compliance program. But the concept is that a lot of the onboarding for telehealth and telemedicine, first of all, should be considered a natural approach and more in demand, because we are just more open to it now, and the public will be demanding for this. And so the level and quality will go higher as a result. And we want to make sure that if you're an acquirer or a banking partner or PayFac, and you are coming across these type of traditionally high-risk customers, which still will remain high risk, that you know how to be able to onboard them well, and just to look at them a little bit closer when there's demand for these type of services.
It's amazing how the world is changing. This is happening in a very high speed. And one of the things that I've seen change, which is quite a basic thing today, but a few years ago, we were not really paying attention, is how exposed we are to public information and public media. Anna, I would like to ask you, within the context of high-risk customers, how important is adverse media today? And how is adverse media integrated in our enhanced due diligence? And why should we incorporate adverse media screening in our ongoing monitoring?
So adverse media is a very valuable information. We get information about our client, publicly available information, and it helps us uncover hidden risks that the customer may not have disclosed for our company. Now, how do we treat adverse media? It's like a red flag for us. It doesn't necessarily mean that the customer is involved in illegal activity, but must be an integral part of our enhanced due diligence. So if we have adverse media, we conduct more background checks about the client. And of course, we consider that information in the risk profile of the customer as a first step. And we treat the information in a way, what if the news or the adverse media information is indeed true, but also consider the other side. What if the news are not true? And this takes us to the second step to evaluate the source of information. Does the information come from a regulatory body? Is it an announcement from the regulator? Is it from an official government publication, from reputable news agency, or is it from a website that we never heard before? And then we move to the third step. Adverse media should trigger an investigation, should check the customer activity, whether there are indications that the customer may be involved in the specific activity indicated in the news. So it's very important on onboarding and during the business relationship to perform background checks and adverse media checks, especially for high-risk customers.
Yeah, what you said is true. I mean, it's very easy nowadays to write something about somebody and that thing can go viral, right? It doesn't mean it's true. It doesn't mean it's reliable. You should always check your sources, always check, maybe there's a bit of bias behind something that's out there. Yet it is really important to take it into account because usually where there is smoke, there is fire. So, taking this into account is really interesting. And we did say, I would say quite a few times that the world is changing. And I remember, from the time I was a private banker, I didn't really have access to a laptop at the time. I am not old, it's just technology. It's just something new. A laptop and a mobile phone was a luxury. But today, when we're talking about private banking, we talk about robo-advisors, we talk about sophisticated investment platforms. So, technology has grown, especially during the last few years, and it's all around us. So I would like to ask Volker, with this booming technology, how has technology impacted the criminal abuse of private banking relationships? How has it made it easier for criminals to abuse this sort of relationships, do you think?
So I think that technology is changing a lot on both sides, or on all three sides, I would say, both on the side of organizations, of customers, but also on criminals trying to exploit all of this products and services a bank or other organizations are offering. And in the context of private banking, I think it's getting more and more sophisticated on how we service our customers, providing them around the clock services for advising with all of these robot advisors or other technical means. It also means that our customers are getting more and more in touch with us. So it's changing also with the introduction of like real AI with ChatGPT. I think the way we are servicing our customers will also change tremendously, and we also need to be aware of the risk associated with it. And this could be, and we all see what AI is capable nowadays of in providing fake news, in providing fake photographs. So when we are dealing with a customer via remote access, via cameras, who is saying that this Holger here is actually a Holger and not someone else, just using all of this all of this AI capacities to look and sound like Holger. This here, it's just a webinar, so no harm done if I'm not Holger, but someone sitting, I don't know, in India or the Philippines and pretending to be Holger. But if ever I'm a private banking customer and my private banker is getting instructions from me to send funds to a shell company, and this is actually not Holger, but someone from Nigeria, the Philippines, or South America, or whatsoever, then it's posing significant risks and threats for both the relationship, but also financial threats for all sides. So it's changing, but we need, as with all other emerging threats and technologies, we just need to think about how we cope with it, how to implement further safeguards, and how to make sure that we are not the ones being exploited here.
Thank you, Holger. Faisal, we already talked about this, but I would like your take on, how can we use technology in our favor, and how to ensure we're one step ahead of criminals? Usually we're one step behind, but how do we, we find that, balance and be one step ahead?
We're one step behind because we're inherently less competent than criminals. As a compliance community, anti-money laundering community, unfortunately, the truth is we are much dumber than criminals are. Criminals are a first adopter of new technology, of new methods. We just are not. It's actually the only field where the countering individuals have equipment that is far less sophisticated than criminals. I mean, think of it for a second. Criminals in the real space have guns, so the police officers have guns. In a situation where criminals, for example, have very fast cars to evade police, police also reinforce their cars solidly and also quickly to be able to chase them. In the compliance community, in AML and financial crime space, we just are always one step behind. Criminals, for example, use Tor networks to be able to connect onto their platforms, use decentralized services, use private messaging services. In the compliance community, there is not a day that an analyst has to help for how to be able to hook up their Outlook. So we just are inherently more competent, more incompetent than criminals, and we have to just get smarter about it. So one way is to be able to use a lot of the products and services that criminals use. They use Tor, we should use Tor. They use air-gapped computers, we should use air-gapped computers. There's a natural habit that's created in the way you counter a certain risk by adopting the same type of tools of the people that are trying to harm you. You get smarter, you learn devices and methods. Here's another one. Anna talked about the need for adverse media screening and how important it is. Here's the unfortunate truth. We're not going to win this war. And I'm sorry to feel this way, but a lot of private banking clients hire specialized firms who they pay $1,000 a month per customer to be able to make sure there is deep cleansing. And I'm talking about deep cleansing in the time of web media to be able to make sure that there is no incriminating evidence and any type of negative media against them. That's how much they pay. They invest up to $1,000 a month to be able to do this for them. Compliance companies and financial service providers spend $1,000 a year on adverse media screening technology. So there isn't an area where we seek to win. I mean, we're not going to seek by just God's good gracious. If we just go ahead and invest, use the same equipment and invest equitably, or at least close to equitably, we'll be able to get the sort of 8x ROI we're trying to get on the compliance front. A little bit of a pessimistic view, but unfortunately, that's the truth we have to live with.
Yeah,
and I totally agree with Faisal that we are, and not only with all of these new technologies, we are always a step behind the criminals. And what we need to make sure is that it's only one step, and that we are not falling back like 2, 3, 4 steps, because then we are getting in a bad situation. And I was asked by a participant one time that we are losing the war, and Faisal said that we are not winning it. And I totally agree with both. So we are not winning this war, but we cannot afford to lose it. And this is why it's so important for us to further educate ourselves and make sure it's one step that we are behind and not more.
Thank you very much. Guys, we have discussed so many things over the last hour. It just flew by, and we still have 3 minutes left. So I will take a question from the Q&A box, and I will ask all of you to respond to that question in your final thoughts. It's one question we all get many times, right? We talk about source of wealth, we talk about source of funds, we talk about enhanced due diligence, getting more information, adverse media. How much is enough? I have some experience from a few years ago when we had a regulatory visit and we're producing these huge box files of information, which actually meant nothing. So, how far do we go, and how much is enough in terms of enhanced due diligence, source of wealth, source of funds, documentation, to protect ourselves from high-risk customers? I'll start with Anna, maybe.
So very briefly, I would say that until we are in a position to prove to the regulator that we have effectively mitigated the risk associated with the customers and that the customer is not abusing our products and services, we can collect 10 documents and the information provided to be enough. We can collect 1,000 documents and the information provided might not be enough. So the overall, what we need to do is to be able to prove to the regulator that the customer is not abusing our products or services.
Holger, any thoughts on that?
Absolutely, a lot, but I'm trying to keep it short. So first of all, we talk about KYC and CDD-EDD on the one side, and it's different topics. CDD-EDD is legally defined steps that we need to do, where KYC is the big picture. The same is true with source of wealth and source of funds. Source of funds is legally defined as the funds used to fund a specific relationship, product, or transaction. And by law, with high-risk jurisdiction or specific high-risk customers, we need to identify the source of funds. I'm not aware that we need to identify the source of wealth in many jurisdictions as a legal requirement. Still, in a risk-based approach, it's often done. And source of wealth is the bigger picture. And you ask, what is enough? Enough is when a knowledgeable third party like an auditor or regulator reads through our source of wealth narrative, and the source of wealth narrative is telling a story, and after he read it, he feels comfortable to know why this guy is filthy rich, and numbers help. So if you can write down the customer worked for so many years in this position, this is what he was earning. So this is why he's accumulated this wealth over time. He sold a house for this amount of money. He sold a company for this amount of money. Numbers help. Then it's all adding up to a picture where we feel comfortable to know about the source of wealth. And sometimes it's one sentence. This guy is just Elon Musk. This guy is just Warren Buffett. And this explains where the wealth is coming from. If you would explain where Gregory's or my wealth is coming from, if we would be filthy rich, obviously, then it would require significantly more documentation and explanation from where it is coming. And we also need to have at least a sufficient level of evidences around it. This could be articles from the newspapers where it's stating that he sold a company. It could be tax declarations from previous years, and so on and so on. So numbers help, a bit of evidence we need, but when is it enough? It is like with every other topic in risk management, it could always be scrutinized. One will say it's too much, the other will say it's not enough. So
essentially making sense of it all. That's where we're heading. Faisal, your final thoughts?
Yeah, I mean, I have to disagree with my other two panelists there. I think the regulatory requirement is sort of like a really bad meter in order to find out what's enough. If the regulatory prescriptions was what was needed to be able to mitigate financial crime, they would have been solved now, right? And it's not, which means the regulatory prescriptions are sort of what allows you to be able to tell to the public that you're doing it right. But secretly, you have to know that, no, there's so much financial crime still going through it. But hey, you've met the regulatory prescriptions, you should be fine. It's unfortunately the only meter we have to be able to expose and test ourselves that we are doing the right thing. The way you should be able to do it is how much actual dollar risk do you lose by reviewing, let's say, $1,000 transaction versus a $1 million transaction. And then you have to push your efforts towards the one that has the high dollar amount of loss. Unfortunately, that's not what regulatory prescriptions are. You're scrutinizing a lot of $500 transactions and really not focusing all the experts and exposures to $100,000 transactions. So my recommendation was, if you really care about thwarting financial crime, direct it only towards where you have the highest amount of exposure from a dollar and economic point of view, because that's also what your adversaries care about. They don't care about regulatory prescription or meeting a requirement. They care about their profitability in those transactions, and you should direct your efforts towards that.
Thank you so much. Guys, I'm really sorry we're out of time. We're already a couple of minutes over. It has been a wonderful discussion. Thank you all for participating. Thank you to all our attendees for their wonderful comments on LinkedIn and in the chats. And hope we can do this again. I think we can be talking about these topics for hours. Thank you so much, and see you again very soon.
Thank you very much. Take care.